If you're a dividend investor, you've probably heard that dividend yield matters, or that diversification is key, or my personal favorite, to never sell, which is usually ingrained in all of our psyches as investors. But, and this is huge, so I want you to listen up, what if I told you all of these little rules of thumb or dividend investor decrees are actually butchering your overall returns and thus financially limiting your upside? Now, some of you may be all up in arms about this, but the reality is all three of these dividend investing notions should be explored, thoroughly understood, and most importantly, implemented immediately with the right intention to ultimately ensure the one thing that matters most for all of us, dividend investing or not, total return. And I'm just going to come right out and say it. Anyone, and I mean anyone, whether it's a YouTuber like myself, the know-it-all Jim Cramers of the world, close friends of yours, or a mentor who shares that investing is not all about total return and prides themselves on some other metric, well, that's someone you should really stray away from and not seek guidance from, because they're going to lead you astray on this financial freedom journey. So I want to go ahead and discuss each of these ideas a little bit more in depth with all of you so I can actually help you reach your financial goals much quicker. With that, let's go ahead and discuss dividend yield and how it actually matters. Now, yes, of course, if you're a dividend investor, then it's a no-brainer that dividend yield matters. It's incredibly important. However, it seems to me that investors are either getting all mixed up, informationally overloaded, or really just not doing their due diligence on the matter, because I'm seeing far too many young investors all wrapped up in high dividend yield, low appreciation investments. And on the converse, I'm seeing older investors just taking on a bit more risk than they really should be, when the dividend yield should definitely matter much more to them. So again, yield certainly matters, but the key metric here that actually matters more, in my opinion, is your age. It's as simple as that. Now, of course, I was once guilty of chasing higher yield dividend stocks out of the sheer allure of receiving higher dividends, whether that was on a monthly or quarterly basis. But I'm going to go ahead and pose to you the same question that I posed to myself, which changed everything. Why am I actually investing? Is it really to bring in dividend income when I don't necessarily need it? Am I trying to live off of dividends right now? Do I want to live off of dividends in the future? Am I nearing retirement with a necessity to use the income today? You see, that one question of why you're actually investing matters, and it will all make a difference for you when you reach that finish line of yours. This simple example that I always use and I love to share is Verizon, the telecom behemoth that traps almost every new dividend investor. Now, you'll see that Verizon year to date is in the green, up by almost 4.5% on the year, and of course, all eyes have been locked on this dividend yield here, which is up at 6.67%. Impressive. And now, if I were to compare that to, say, one of my personal stocks in focus, United Health, which comes in at a much lower dividend yield of 1.5%, you'll see for yourself that a stock like this wasn't really necessarily performing all too well on the year before ultimately pulling ahead of Verizon at the year's end here and appreciating by over 16%. But this is where you absolutely must understand the power of time in the market and click out to the 5-year view to see that United Health ultimately outshined Verizon with over 132+% worth of appreciation. Now, what exactly does that mean for you in terms of this total return deal? Well, 10 years ago, if you invested $10,000 into Verizon, like most dividend suckers or newbies out there typically do when they get duped by dividend yield mattering much more, you'd only be sitting on $14,351. That's about a 3.6% annual return rate. That's not a loss, but certainly not the 21% annual return rate that United Health is gifting investors. That's over $61,000 worth of a return. Now, which one would you rather sit on? It's a no-brainer in my opinion. But certainly there's a time for the Verizons of the world, and that time is when you're nearing retirement. So just full circle here. Dividend yield matters, but your age matters much more. And you should definitely dedicate some time into looking into these stocks and their yields before investing into them. Now, this leads me to shatter the diversification is key myth, or the law that we all follow and often fall trapped to, which crushes our chances of really maxing out on that total return. But before I go any further, I just want to say that I'm coming at this diversification idea from the standpoint of someone who really doesn't have millions of dollars to invest and therefore really needs to be strategic and careful with how many holdings I actually have in my portfolio. Because, well, I only had limited capital. Therefore, every dollar that I invested It needed to be invested wisely and intentionally. However, what I see most investors doing is buying anything and everything that they can when they can, which means their portfolios really become overloaded with 60, 70, 80, or heck, even 100 plus holdings. Now, not only is it nearly impossible to track every holding in these supersized portfolios, but this is exactly what an exchange traded fund or an ETF is for. But if I'm here to say that you should totally avoid overloading your portfolio in the name of diversification, then what am I personally a fan of doing? Keeping your portfolio to what you actually enjoy investing into, understand, and most importantly, just realistically can actually manage as an active investor. Now, its set a portfolio of 7 to 10 or up to 20 to 25 stocks is not only manageable, but any holdings count past these numbers adds almost zero value to you. But I'm here to argue it actually hurts you, again, coming at it from the limited capital perspective, just based on all the math. So let's just say that you're working hard day in and day out, and you're earning the US average salary of $63,795. And after all your expenses at the end of the month, as well as all the nights out, you have $1,000 to invest, which unfortunately isn't even the case for most of you out there. But that means your $1,000 is split between just say 30 stocks. That works out to about $33 in each holding, which is not enough to load up on any one particular holding or even really build a strong portfolio. Yet, if you decided, as I did, that less is actually more, your $1,000 split amongst, say, 7 holdings means $142.85 invested in each stock. Of course, I know this is not exactly how you invest per se, but this should all just say that you want to build up high conviction positions in holdings that actually yield some real powerful returns versus scraping by, picking up pennies and dimes along the way from the dozens upon dozens of holdings that you may have in your portfolio. Now, just before I cover the last and arguably the most important investing idea that has been totally misused or overstated, investors, if you're getting value from this video, I can only guarantee plenty more information where all of this comes from with stock ideas, economic insights, and the all-popular Masters of the Market chats every Monday. So subscribe to catch it all. And if you're getting value from this particular video, let me know by tapping on that thumbs up button so I just keep pumping more content out like this. With that, let's now talk about the notion of never selling, or rather the buy, hold, and never sell approach to investing, which I'm going to admit now, even I'm guilty of saying every now and again, as you probably may know. I mean, who wouldn't want such an opportunity to literally just buy and never sell? But the reality is you need to become an investor and remain an investor. That means someone who is going to unemotionally and very objectively look at their holdings within their portfolio and just act accordingly. Should a position no longer serve its purpose in your portfolio or fit your investor profile, do not be afraid to sell. Now, if a stock hasn't been performing up to par or your expectations and your capital could be easily earning you more elsewhere, don't be afraid to sell. Or of course, if the red flag pops up and that dividend yield is cut, don't be afraid to sell. In other words, I really just want to hammer this one home. We all, including Dalio, Munger, or Buffett, at times make a mistake, miscalculate, or strike out on our investments. But as most of the Wall Street sages out there say, you don't have to be right 100% of the time. So for your portfolio's losers, or the stocks again that just aren't performing, or a perfect fit for your portfolio, sell without regret, learn your lesson, and get on with taking the next right steps to driving a higher ROI for yourself. Unfortunately, I think far too many investors out there are getting trapped by this never sell notion, and they really hold on to positions for far too long, which ultimately leaves them shortchanged at the end of the day. So don't get married to your holdings. Be an investor, invest intentionally, and most importantly, with a purpose. After all, this whole game isn't personal, it's strictly business. With all of that said, let me know some of the ideas that you ran with for far too long, or what you feel has been actually holding you back as an investor. Comment down below. And if you want to learn some of my biggest mistakes as an investor that you should totally be avoiding entirely, watch this video right here, but be sure you're subscribed to the channel, and I'll catch you all in the next one.